All right, what is up, guys? It's been a minute, I guess 2 weeks. For those who don't know me, my name is Arbaz. I also go by AA Bands Effects. If you're new to my channel, welcome. I'm a day trader who's made over $350,000 through proprietary trading firms. And listen, I'm here to help you become profitable and teach you concepts that nobody in this industry is doing. In this video, we're going to cover how you can tell a day is low probability, especially on the NASDAQ. Now, this isn't going to be a too long video. It's really simple, but a lot of you guys love to trade the NASDAQ and you love trading ICT concepts. Specifically, there's one concept called the inverse fair value gap that is very widely used. And I'm here to tell you that if you use these concepts when you are in a low probability day, you are going to blow your account. And guaranteed, this is literally what goes and happens to everybody, but they just don't show you. So let's get into it. We're going to look at some recent price action here. This is on the NASDAQ. As you can see, this was around July 28th, 29th, and 30th. As you can see, I've kind of marked out these boxes, and usually what day traders and ICT traders and, beginner traders in general, they like to characterize chop or low probability days as consolidation. So that's how we're going to go about this, right? Now, here's the tricky part about figuring out if a day is going to be expansionary, consolidating, or whatever, accumulating, whatever you want to call it. You don't know until you actually know and it's happening in real time, but there are a couple things you can use to kind of mitigate your risk and prevent you from blowing out on the day and, getting your account just completely cooked. So I have a flow chart right here, very simply put, to explain to you what happens on low probability days, how to avoid them, and how you can navigate them. So number one is having a daily loss limit, guys. You genuinely do not want to be over trading, revenge trading, taking bad setups in a consolidation based environment, which is low probability, because, well, what's going to happen? You're just going to keep getting stopped out trying to catch a breakout or a big move, 3-4 RR, and it's just going to keep chopping you up, and you're going to try to play the breakout or a trend expansion, and you're going to get cooked. If I were to bring my tool to this day, we're looking at the 5-minute right now, like I said, on the NASDAQ. A lot of you guys, like I said, use the inverse fair value gap concept, which is a very common concept in ICT, trading. So quick little refresher, guys. Remember, an imbalance is defined as a 3-candle pattern. Before, I used to kind of refer to it as a FVG. I mean, we still can refer to it as an FVG. Imbalance, fair value gap, same thing. So let's just say fair value gap. A fair value gap is a 3-candle pattern of where the middle candle has an expansionary move up that leaves no bottom or top wick, and there's kind of like a gap between the wick of the previous candle and the future candle, the next candle. Usually, we expect price to retest these imbalances and go higher, right? A very simple, diagram is going to be if we're trending higher like this is market structure. We might have an imbalance right here. We, retest an imbalance and then we go higher, right? Very simple stuff. Now, when an imbalance fair value gap gets invalidated, this is called an inverse fair value gap. This area right here is now an inverted, right? That fair value gap is inverted, excuse me. And what people like to do is when they see a nice engulfing candle with volume behind it, they are going to market order sell or buy. Now, remember, in a low probability condition, right? This is not going to work out. Most people like to use 1-minute fair value gaps. And let me show you something. If you marked out, let's say, for example, this 1-minute fair value gap right here, we're going to just label this, green, just for purposes, right? And we actually made it more specific. We take it from the wick to the wick like this. Well, you can see what happens here. We close right above the fair value gap right here to invalidate it. And if you had took a long position, you market order bought, stop loss right below the swing low, something simple going for a 1 to 2, which is again a very common setup, you would have been stopped out. If you then keep trying to apply the same logic, this strategy, this concept in both directions, well, again, you're going to keep getting stopped out, right? And what's going to happen is sure, you might, take a winning trade after you've taken 5 losing trades. You're still losing on the day. Because what is this model contingent on? This model is contingent on the fact that it is going to continue in a certain direction, right? It's going to continue in a certain direction. But if it's doing this, right? If it's just doing this, well, it's just invalidating the inverse fair value gap. So you just get cooked. So the only way to actually deal with and counteract these days is to have a daily loss limit. You guys know, I know it's super simple, but it's so critical. 2 to 3 trades on the day, and that is how you manage your risk. I don't care what you are doing. It should be simple to just prevent yourself from over trading and taking more than 2-3 trades on the day. Now, here's the second part. Did an expansionary move occur already previously in Asian session or London session? If the expansion, as you can see, happens beforehand, there's a high probability that the New York session is going to be a consolidating session. So let me delete all this stuff here really quickly. And as you can see this didn't necessarily happen in London session. It's kind of near the end of London, the overlap. But you can see an expansionary move already happened. happened, right? We have an expansionary move that already happened, then we continue to chop. Same thing here, we had a gap up, an extreme gap up, and then we end up chopping. Now, in this case, it didn't happen. The expansionary move happened after, which is what you want to see. Now, you can kind of see how this is being put together. This is kind of like a PO3 AMD type of situation, where we have an accumulation, we then have a manipulation of that area right here, like this, and then we then expand to the upside like this. And then obviously we play the expansion with an inverse fair value gap or something like here, or something of that matter. Finally, the last thing I want to give to you guys is, how do you trade these conditions when you've kind of recognized them? You basically trade the extreme supply and demand level. So you can see right here, when we are in this consolidation, and let me actually delete this right now, you can see we are reacting off the extreme level of demand and supply, right? We have a level of supply right here, we have a level of demand right here, and in general, we are, just trading off these levels, right? Very simple stuff, right? We are reacting off our supply, we're then reacting off our demand, right? So literally, guys, super simple supply and demand. You always want to trade like this when there's consolidation, and you can see this extend even into the next day, right? Now, obviously, if you don't want to do any of this, you don't want to, micromanage and try to apply all these concepts, the number one takeaway from this video is having a daily loss limit. Because say you have a strategy, you want to use that inverse fair value gap strategy or whatever, you don't want to worry about anything else, you have to protect your downside risk. And listen, this is the only way to do it. 2 to 3 trades a day, and if you lose 2 trades, 3 trades on the day, you walk away. It is that simple. Hope you enjoyed this little lesson, guys. I'm going to bring you lots of good content. We're going to go super crazy, as I said. If you want to work with me one-on-one, you want to apply for my mentorship, link is in the bio. If you have any questions, shoot me a DM on Instagram. I'd be happy to help. And drop a comment down below. Let me know what your favorite ICT concept is, so I know you watched the video. And with that, I'll take my leave. Take care.